And obviously, you all know him and just looked up in Wikipedia what they say about him. So Joseph Stiglitz, born February the 9th, is an American economist and a professor at Columbia University. He's a recipient of the Nobel Memorial Prize in Economic Science 2001 and a John Bates Clark Medal 1979. He's a former senior vice president and chief economist of the World Bank and is a former member of and chairman of the US President's Council of Economic Advisors. I think that says it all. We're very pleased and honored to have him here. Please, Professor Stiglitz.
It's here. Oops. The gentleman will help because he said.
Yeah.
Have the presentation.
Yeah.
Yes. This. Where is?
Should be that. Yeah.
Where is your presentation? Is this?
Yeah.
Yes. This is presenter for next.
Okay, fine. Well, it's a real pleasure to be here, although the economic circumstances may not be the best in the world. So I know that among financial people, you're supposed to be very optimistic. I can't do it. So I'm going to try to give a balanced view, as optimistic as I can be, but as you'll see, it won't be very, very upbeat. But at least it's not an after-dinner talk where you'll get indigestion. So the issue is, what is the state of the global economy? Why is it in this state? What can be done about it? Where is it likely to be going in the next few years? So 2015 is slated to be the worst year since the global financial crisis, and apart from the global financial crisis, is actually one of the weakest years in recent decades. If you look at the array of forecasts for 2016, most of them say that 2016 will be better. But if you look at the underlying forces that I'm going to be describing in a few minutes, I find there little reason to expect any significant improvement. What one sees is weaknesses everywhere. The most striking, of course, is the slowdown in China, with knock-on effects, especially in those countries dependent on exporting its natural resources. And many of those, probably most of those, had failed to take advantage of commodity price boom to adequately diversify their economies. So I just came back from Latin America, and I was also in South Africa, and there's a sort of sadness about this because they are now realizing that that moment, that previous decade with high commodity prices is almost surely over, and they didn't seize the moment. So now they're talking about what they should have done, but that's the past. And they're stuck with where they are, and unfortunately, where they are is not where they would have wished to have been. I should probably comment that there is some disagreement about what exactly the growth rate of China will be, but actually for Western economies, much of that debate is irrelevant. Because what is absolutely clear is that the growth in China, the part of the growth of China that has been so important to Western economies, that part is basically over. So in other words, their service sector may grow faster than we hope or than they expect. It may grow somewhat slower. But Western economies won't benefit that much from a growth in the education sector, the healthcare sector. They'll benefit somewhat. So those are the elements of the uncertainty of Chinese transformation. The parts about which there's very little uncertainty is that there won't be the demand for iron ore, copper that had marked the previous decade. Meanwhile, there's continuing weakness in Europe. While there's a certain celebration over the fact that the Brexit seems to have been solved, I think that's false optimism. It's just been postponed. I think the likelihood that the next round of the Greek crisis, or I will say the European crisis, will break out. Portugal is already breaking out into a crisis. As those who have followed in Portugal, 62% of the voters, remarkably similar to what happened in Greece, 62% of the voters rejected the party of austerity. And they are now having a difficulty putting together a coalition government. The program that the Troika imposed on Greece is guaranteed to make sure that the depression continues deeper and longer. And the question is only a political one. How long will the people in Greece be able to take that kind of suffering? The Eurozone program, the Troika program in Greece, even with a restructuring of the debt, if the primary surpluses that have been mandated are kept in force, is a guarantee for the Greek depression to continue. The continuing austerity throughout Europe is having its toll. And meanwhile, in the United States, while we look across the Atlantic and we are proud that we are doing well, we're doing well only in comparison with how badly things are on the other side of the Atlantic. Our growth no one would say that our growth is really success. We do make a big deal about the fact that the headline unemployment rate is down now to around 5%, less than half of that of Europe. But that masks a high level of unemployment, of disguised unemployment. You're not unemployed if you work 1 hour a week. Of course, you're not employed in a meaningful sense. You're not unemployed if you've given up looking for a good job because there are no jobs. But of course, again, you're not employed. So any real measure of unemployment for the United States, talking about the weaknesses in the labor market, would suggest that the true unemployment rate, whatever that means, is at least 12%. So that and labor force participation in the United States is as low as it's been in decades since women first entered the labor force. So no one says that the U.S. is performing well. Part of the reason is that we have a mild form of austerity, not as terrible as Europe, but we do have austerity. We have about 500,000 fewer public sector employees than we had before the crisis. And normal growth since 2008 would have meant that we would have had about 2 million more public sector employees. So the shortage of public sector employment of 2.5 million is exerting a severe toll on our economy. And meanwhile, I know all of you are amused at the shows that our primary, particularly on the Republican side, puts on with great amusement. It looks like a comedy show, but it is really quite serious, and it has serious implications for the United States. But it is a part of the broader gridlock, political gridlock in which the United States is. All of this leads to the view of what Madame Lagarde, IMF, has talked about is the mediocre performance of the global economy. To give a view of what is the state of the U.S. economy and the state of the Eurozone, this chart shows the red line shows the trend growth from 1980 on. And what you see is a fairly smooth curve, a little bumps here and there, between 1980 and 2000. And that continued, of course, until the crisis in 2007, 2008. And what you see is the green line is where we are relative to where we would have been had we continued in that smooth growth. And what is very clear is that the gap between where we would have been and where we are is increasing. And what all of that says is something that's not a very big surprise. When you have 5, 6 years of very poor economic performance, not only don't you close the gap, but the rate of growth is actually slower. There are long-term effects. Just the technical term economists use is hysteresis, but you don't really catch up. It has effects on long-term potential growth rates. And the Fed has done studies showing the magnitude, the significance of the effects that are really illustrated in that. But if you think about the mild economic downturn in the United States and the much larger downturn in the Eurozone, will come not a surprise that these effects are much larger in Europe, and that's shown in the next graph. So again, you see the trend line of growth. I've just done it for the Eurozone because I think that's where the key problems in Europe lie. What one sees a little bit striking in this graph is that in the period after the creation of the Eurozone, 1999, the start of the Euro in 1999, you don't see any faster growth. In fact, there seems to have been no benefit to the Eurozone for the creation of the Euro. But what you see is after the crisis of 2007-8, the plummeting of growth and the fact that the gap between where Europe would have been and where it is, large and increasing, and not even a recovery in growth rates. And I think unless policies change in the Eurozone, this pattern is likely to continue. So what I've depicted in very broad terms is the very poor state of the global economy. And that naturally asks the question, why? And the answer that I would put forward is there's a lack of global aggregate demand. That just pushes the question back one step. Why is there this lack of global aggregate demand? And I think there are several parts of the answer. No one fully explains what's going on. One of them is the growing inequality in most countries around the world. Why does the global inequality matter? Well, those at the top consume a smaller fraction of their income than those at the bottom. So when you shift income from the bottom to the top, something that's been going on in most of the advanced countries, you get lower overall aggregate demand. And this is part of the new view, a view not only that I pushed in my earlier book, The Price of Inequality, but now has been adopted as the official view of the IMF. Lower inequality, more equality, is associated with better economic performance, higher growth, and more stability. If we have time in the question period, we could talk about why this is, but this view that equality is good for growth is now becoming more firmly established across the board in economics. The second reason why we have this lack of global aggregate demand, which is weighing down on the global economy, is the widespread austerity. Government cutbacks or limited growth, as I mentioned, is true in both the United States and Europe. The third is a somewhat deeper explanation. It's part of the explanation of the growing inequality in most countries. It's part of the problem facing the United States and Europe. But it's also a part of the problem facing China. And that is the need for structural transformation, major changes in our economy. About a century ago, we faced a similar kind of need for structural transformation. The global economy, the advanced countries, were going then from agriculture to manufacturing. And that kind of dramatic change in the structure of the economy doesn't happen easily on its own. Today, the analogous transformation is in response to technology and globalization, is a transformation from manufacturing to a service sector economy. Globally, the number of jobs in manufacturing will be going down. And that's simply a result of the success that we've had in productivity. Productivity growths in manufacturing have far outstripped increases in demand. And a corollary of that is that global employment in manufacturing will be going down. So those countries that say, oh, we have to maintain our manufacturing jobs are living in a fantasy. It won't happen. And meanwhile, the share of those global manufacturing jobs that will be captured in the advanced countries is also going down. Because this is globalization. The comparative advantage is such that a larger fraction of those jobs will be in developing countries and emerging markets. So here in Europe and in the United States, we will be having a smaller share of a smaller market, and that means our workers have to go somewhere else. As I say, it's very much like in agriculture. Back in the 19th century, 70% of all workers were in agriculture. And then we had enormous increases in agriculture, in the productivity in agriculture, to the point where today, in the United States, for instance, 3% of the labor force produces more food than even an obese society can consume. So it was a success, but it also meant that labor, jobs, had to go somewhere else. But markets on their own don't manage this kind of transformation. And I've argued that, in fact, the Great Depression represents a bump in that process of restructuring. Well, we're now going through another bump, a very serious bump, in that restructuring from manufacturing to a service sector economy. We're not the only countries, Europe and America are not the only places going through this kind of global restructuring, structural transformation. In China, it's going through a very difficult process of restructuring itself from an export-led growth to a domestic demand-driven growth, from what's sometimes called from the quantity to quality. Again, that process is a very difficult one. For those in the West, it's important to realize that that structural change from export-led growth to domestic demand growth is not going to necessarily lead to an increase of imports from the West. A lot of people just assume that when they go from exports to domestic demand that it will generate imports from the United States and Europe. But the domestic demand-driven growth will be focused on things like health and services, health and education, which will not directly increase demand for Western goods. The fourth aspect of the weaknesses in global demand have to do with global imbalances. Global imbalances arise simply when major blocs, major countries export more than they import. So the problem is that they produce more goods than the demand for goods that they create. And unless something, that surplus that's generated is recycled in somehow, there'll be a lack of global demand. Before the crisis in 2008, a lot of people spoke about the problem of these global imbalances, China's surpluses, as contributing to the weaknesses in the global economy. Ben Bernanke would talk about a savings glut, which is another way of his attempt to shift the blame from America's macroeconomic mismanagement for which he was responsible to China. But today, if we look at those global imbalances, the major source of global imbalance is here in Europe. The Eurozone is the major source of global imbalance. It's not China anymore. China's imbalances have come down, and Europe's have grown. And basically, the story is very simple. Germany maintained its surpluses. It forced the periphery countries to go from deficit into balance, and that meant the total surplus for Europe has increased significantly. And so Europe today is the major source of global instability, of global imbalances. And finally, what I call asymmetric adjustment. Countries facing a decline in income have to reduce consumption. Those with increased income do not expand spending symmetrically. And so when you have a shock, it's almost inevitably the case that there's a reduction in aggregate demand. And you see this right now with the oil price shock. There was a moment of hope when the oil came down, price of oil came down, and everybody focused on the fact that Western countries were going to have more money in their pockets because they were going to be spending less on oil. But what people didn't focus on was that there would be less money in Saudi Arabia and the oil-producing countries. And they didn't focus on the fact that the oil companies, hydrocarbon companies, would not be doing as much investment in drilling and other kinds. One of the real sources of growth had been the expansion in oil drilling in the United States. It was one of the sources of growth. North Dakota, it was one of the big sources of growth. And what you read almost every day is the cutbacks by the oil companies in their investments. They have no choice. The investment projects that were put in place in the prospect of $100 barrel oil are going to cut back when the price of oil is $40. And meanwhile, countries like Saudi Arabia and the oil exporting countries whose budgets were predicated on $100 oil now face $40 oil. And they try to get by for a little period, but now they can no longer do it, and they are engaged in massive cutbacks in spending. So that kind of asymmetrical adjustment, which we often see, is another major source of lack of aggregate demand. Now, I mentioned before the surpluses like in China and Europe. Those surpluses would not be a problem if the funds could be recycled. But if they're not recycled, you wind up with a large amount of savings that is not being put to good use. And that was where Ben Bernanke talked, as I mentioned before, about a savings glut. Now, when he said that, I sort of thought, in a sense, that he was living on a different planet than I was living in. Because I traveled around to emerging markets, I saw huge needs for infrastructure investment. I saw huge needs for investments in education. Even in the United States, anybody who visits New York City knows that we need infrastructure investment, and we have bridges that are collapsing. So all around the world, there's a need for infrastructure investments in education, investments in technology. The meeting next week in Paris is going to remind us that we need huge investments to retrofit the global economy for global warming, for climate change. We're going to need to have investments in transportation systems, in electric generation systems, in systems of the structure of our cities and our housing. So the fundamental thing is that we have these huge, really, literally huge investment needs well beyond our savings So he was just wrong when he said that there was a savings glut. But what was right is something wasn't working. And what wasn't working was the fact that standing between this savings on the one hand and the investments on the other hand were dysfunctional financial markets. Financial markets are supposed to intermediate, bring together investment and savings. And that's the way we've always talked about financial markets, as intermediating. But they weren't doing that intermediating. There's actually an even deeper problem. Most of the investment that I described before are long-term investment projects. And much of the savings is long-term savings. Savings for retirement. Trillions of dollars are now held in sovereign wealth funds where their savings is being held not only for this generation but for future generations. So these are long-term savers and these are long-term investment projects. But between these two, standing between these long-term investment projects and the long-term investors are short-term myopic financial markets who measure their performance on quarterly returns. The fact is that these financial markets have not been able to recycle the surpluses. We've recognized that something is wrong with our financial markets, but most of the discussion since 2008 has been centered on preventing the financial markets from imposing harms, from excessive risk-taking, from market manipulation like LIBOR and Forex, not asking the deeper question, how do we restructure financial markets to perform the functions that they're supposed to perform of intermediation, and intermediation in particular between long-term savers and long-term investment needs. So, to me, the real need is to make sure that the financial sector performs its critical and really important societal roles. In fact, if you look more carefully, today in the U.S. the financial sector has been engaged not in intermediation between savers and investors, but disintermediation. That is to say, taking money out of the corporate sector. The net flow of money out of the corporate sector has been enormous. In 1 year alone, there was about 4% of GDP that went into share buybacks. And with less money inside the firm, there's going to be less level of investment. And with the bank less focused on these long-term investment needs, the level of lending to SMEs is very constrained. In fact, years after the crisis, it was still below, in the United States, more than 20% below the level in 2007 and 8. And in Europe, the declines were even greater. So there's going to be, in this presidential campaign, at least on the side of some of the presidential candidates, an attention on precisely this issue. How do we get the financial sector to be more functional? Not only to prevent the harms, but how to make sure that it is restructured in ways to focus more on the long term. And you'll see that in discussions not only by the presidential candidates, but by some of the leaders in the financial sector themselves. One of the reasons that we didn't return so quickly to growth after the crisis was that there was a misdiagnosis of the Great Recession. You know, the recession began in the United States in 2007. We're 2015, 8 years. And I think most people had not expected a downturn that would last that long. They knew it was deep, but they thought, well, we are so much smarter, we have such great economists that we know so much about economic fluctuations and macroeconomic management that we'll get the economy back to working very quickly. Well, it's not happened, and I want to spend a few minutes trying to explain why it's not happened. It's very closely linked with the remarks that I've just made about the sources of the lack of global aggregate demand. So there were three aspects of this misdiagnosis. In the immediate aftermath of the Great Recession was brought on very transparently by a financial crisis. It was the banks not being able to pay what they owed. The thought was that there was a problem of a sick financial sector. So the idea was a very simple one. We put the financial sector into the hospital. We give it some loving care. Loving care means $2 trillion. And $2 trillion should make people feel happy. And with that, loving care, the financial sector, the banks in particular, it's not the hedge funds, it was basically the banks, was brought back to health. And once that happens, we pick up where we left off in 2007. Well, there were some fundamental, that should have been obvious that was not the full story. It was part of the story, but not the full story. Because even back in 2007, the economy was not very healthy. What kept the economy back at full employment in 2007 was a housing bubble, which allowed the bottom 80% of Americans to spend 110% of their income. And you don't have to have a PhD in economics to know that you can't sustain 110% of your income spending without having a problem. So it was actually clear that we were going to have a problem. But if we went back to 2007, unless the Fed was as successful as it was in the past in creating another bubble, and the Fed has been working hard to create another bubble, but the housing bubble is a particularly good bubble to create because everybody can feel happy. It's not just like a stock market bubble. So unless you create another bubble, you're not going to go, going back to 2007 isn't bringing us back to health. And in any case, a bubble is only a short-term palliative. Well, this idea that the whole problem was just a problem of a sick financial sector meant that all that was needed was a short-term stimulus to help out the economy while the banks were in the hospital. There's no focus on what were the fundamental problems that were wrong, the kinds of things that I've been talking about. And it didn't even matter much how well the stimulus was designed. So it wasn't designed very well. It was too short. And it didn't provide very much bang for the buck. But today, banks are mostly back to health. Not fully, but mostly back to health. But the economy is still not healthy. So that tells us that that first interpretation of the cause of the Great Recession, that it was a problem in the financial sector, was certainly not a full explanation. The second explanation was that, well, governments had overspent. That was an easy solution, an easy part of the discussion in Europe, where you focused on Greece. Greece had overspent, and that was true. But if you look at Spain, you look at Ireland, they had a surplus before the crisis. They had a very low deficit to GDP ratio. So their problems weren't caused by overspending. The crisis caused their deficits. It wasn't the other way around. And still, this view prevailed in many parts of Europe and even parts of the United States, that with the deficits created by the crisis, the only way to restore confidence in the economy was reducing the deficits. So the view was that reducing the fiscal deficit would restore confidence, and that would lead to more investment, returning the economy to health. This is a view that is widely held in financial markets, widely held in some parts of Europe, widely held in some parts of the United States. There, in fact, is no econometric or statistical basis in this belief. It's being studied. It has no basis in economic science. In fact, to the contrary, the evidence is that when you have austerity, the resulting unemployment undermines confidence. This is a theory that I give some credit for the United States for being the origin of this theory. I call it Hooverite economics. Herbert Hoover tried this theory in 1929. After the stock market crash, he tried austerity, and we had the Great Depression. You would have thought, well, that's a good example not to follow. But Europe seems to have followed it. But then the IMF didn't understand that, and in East Asia, they tried that experiment over and over again. And in Latin America, they tried that experiment over and over again. And guess what happened? Every time the result was the same. Austerity led to recessions and depressions. And why they thought the same formula would have a different result in Europe is a mystery to me. But guess what? The same laws apply to Europe that apply to Latin America, applied in the United States. Austerity has led to recessions and depressions. And there's a simple linear relationship. The greater the austerity, the greater the depression. So a few months ago, the chief economist of the IMF said, oh, we were surprised that the downturn in Greece was so great. And then what you saw all over the internet, people started plotting a simple curve. And what it showed was Greece was just on the regression line. If you looked at the magnitude of the fiscal contraction, the amount of economic contraction was just proportional to the fiscal contraction. It was totally predictable. It had nothing to do with all those structural reforms or anything else. Given the magnitude of the fiscal contraction, the magnitude of the economic contraction was exactly what you would expect. There was an idea that a couple of economists at Harvard put forward, a little bit embarrassingly, with this idea that there is such a thing called expansionary contractions. It's a real oxymoron. So it was an idea that somehow by contracting you could expand. And they looked at a few instances that seemed to be true. But when you looked at these instances more closely, it turned out all of them were false. What basically happened in each of those instances was that their trading partners started to grow and grow very rapidly. And so as government spending went down, they were lucky that their exports increased and filled in the gap. Canada was one of those examples where they had a fiscal contraction in the 90s, just when the United States, with its good economic team of President Clinton, was expanding the economy. And so Canada continued to grow because there was an expansion in exports to fill in the gap. But that won't happen in Europe. That won't happen in the United States. The world is going into a global slowdown. Unless you expect to export more to Mars, and you think that there's a boom in Mars, there's not going to be a boom in exports. So fiscal contraction, when all the rest of the world is contracting, is going to lead to a major economic downturn. The third idea that was promoted to try to interpret the Great Recession was that it was a balance sheet recession, and view that balance sheet recessions are deeper and longer. The Great Recession had destroyed balance sheet, and it is true that that takes time for balance sheets to recover. But this is more than a balance sheet recession, and many of the balance sheets have already largely been destroyed, especially the large corporations. In fact, these large corporations are sitting on large amounts of cash, and yet the economy has not been restored back to health. So, what is the source of the problem? Well, the source of the problem are the fundamental things that I talked about in the beginning of my talk. The growing inequality, the structural transformations that I discussed, the global imbalance, the asymmetric adjustments. These are the fundamental things that our policymakers have not adequately addressed. There are major consequences of this macroeconomic mismanagement. Not only lower growth and higher unemployment today, but lower output and growth rates in the future, illustrated by the fact that I showed before, that what you're seeing here is this, what economists call it, the hysteresis effects. When you have young people who don't have a job, The most important part of human capital is on-the-job learning. What we do in school is mostly to train people to learn on the job. I know we like to think of ourselves as being important, but we really are preparation for lifelong learning. But if you don't have on-the-jobs, if you have no jobs, there's no on-the-job learning. This is not a complicated idea. If you have youth unemployment of 50% or 25%, you are not increasing the human capital of a large fraction of your population. And that is what is going on in Europe today. So not only are you losing GDP today, you are losing GDP in the future. There are also political consequences, and those political consequences in turn have economic consequences. There is growth in the extremist parties. Throughout much of Europe, both the center-right and the center-left is suffering. In Spain, the center-right and the center-left are basically destroyed. The same thing is now happening in Portugal. In Spain, there's the growth in separatist movements. In the US, we don't see quite the same extreme, but you're seeing it in a way in the primary that, as I say, I mentioned before, it gives a great deal of amusement to those outside the United States. If you look at those Republican candidates, what you see so strongly is the anger in support of anti-establishment candidates. And it's totally understandable. A few statistics give a picture of what has been happening in the United States. Median income, median at half above, half below, median income adjusted for inflation of a full-time male worker in the United States is lower than it was 40 years ago. Wages adjusted for inflation at the bottom are lower, I say lower, than they were 60 years ago. Now, can you imagine an economic system that doesn't deliver for a majority of its citizens? There has been total stagnation in the incomes of the bottom 80% for the last third of a century. For most Americans, our economic system is a failure. America prided itself as being the first middle-class economy, the first middle-class society. We are now about to become the first middle-class society that ceases to be a middle-class society. The basic prerequisites of a middle-class society are becoming out of reach for most Americans. Something is wrong with the way our economic system is working, and we're finally beginning to own up to it. Well, there are some prescriptions. I said easy prescriptions. I shouldn't have said that. They're not easy. They're certainly not easy politically. Economically, we know what to do. We know what to do both to achieve faster growth and to achieve greater equality and to get out of this malaise, this period of mediocre performance. And that is identify the underlying problems that I mentioned before and begin to address them. So we need government programs. The market won't fix these problems that it itself created. We need government programs, for instance, to reduce inequality, to facilitate the structural transformation. In the advanced countries, among the service sectors that are key are sectors like health and education, which are especially dependent on the government. But if we have a government withdrawing, there can't be that societal transformation, the structural transformation to the service sector. In China, there's a similar process and way. The Chinese government has said they want to make the private sector have a decisive role. But if you look at the key problems in China, the key problems are the environment, you can't breathe the air, inequality. In 30-some years, they managed to get as much inequality as it took America 200 years to achieve. It was a remarkable achievement. But obviously, you cannot have a well-functioning society with that level of inequality. The problem of urbanization, the moving of hundreds of millions of people from the rural to urban sector, creating cities where people, livable cities, where people can live together, won't happen on its own. If you want to see what happens without urban planning, just go to Houston. There are also a key problem of instability, which you see in the excess of growth and credit in China. All of these, the key problems I think that China faces require more government action. And again, these are problems that market can't solve these problems that in fact that it has created. Market mechanisms can be used, and deep reforms in China will be needed to address some of the anomalous characteristics of the Chinese economy: a small share of household income, dependence of local governments on property sales, excessive dependence of economy on credit growth. Globally, there are also a set of reforms that are going to be needed, and these are even more difficult given the lack of cohesion across the countries of the world. For instance, we need a new global reserve system. The dollar reserve system, which is the reserve system that the world basically uses today, is archaic. It's a relic of the early part of the 20th century. The current system leads to biases towards the surpluses I mentioned in the case of Germany, of Northern Europe, and China. The flip side of surpluses are deficits. Economists differ about almost everything, but one thing that economists don't differ about is that the sum of surpluses has to equal the sum of deficits. That's just arithmetic. So if some country has a surplus, some other country has a deficit. But we know that trade deficits can be problematic, because all of a sudden the financing for those trade deficits can disappear. And that can be, these are called sudden stops. And that can give rise to instability. Moreover, when there is a deficit, it's a subtraction from aggregate demand of that country, and that leads to weaknesses in aggregate demand, high unemployment. A few years ago, there was a widespread recognition of the deficiencies in this global reserve system. I wrote a report, I chaired a UN commission that identified this as one of the central failings of our global financial system. We got a UN resolution in support of it. We got the support of China. France was the head of the G20 that year. It endorsed it. As I say, China, Russia endorsed it. We had one problem. I couldn't get Obama to support it. He realized that it actually led to a weaker American economy. But it's sometimes called the exorbitant privilege, the fact that the United States can borrow from other countries at close to zero was a convenience for the United States when it was running huge deficits. So in the absence of the US support, nothing was done. But it is one of the key failings of our global economy, and eventually something has to be done. Now, right now, China is making a big deal to become part of reserve country. I think that's of a reserve currency. I think it's a mistake. It will probably become part of the SDR, but it won't make a fundamental difference to the working of the global reserve system. The fundamental reforms are still needed. We need global coordination to reduce global imbalances. Interesting thing is that China's surpluses are in process of being reduced at the same time that those in the Eurozone are increasing. And unless there are deep reforms in the Eurozone, that is likely to continue. Thirdly, we need better ways of recycling the surpluses. There is a beginning of some efforts to do this. I don't know how many of you followed the creation of the new development banks. And that was the main issue, actually, that came out in the accord between President Xi and President Obama. The BRICS created a new development bank, imagined to be called the New Development Bank. The New Development Bank, the interesting thing, just to put things in historical perspective, the size of the BRICS, those 5 countries, Brazil, Russia, India, China, and South Africa, those 5 countries have a higher income today than the advanced countries had in 1944, all of them together, when the World Bank was established. And that, of course, was part of the thinking that led to the creation of the BRICS Bank. There were other things, of course. The fact that the fundamental reforms of the World Bank and the other multilateral development banks that the G20 agreed on, the changes in governance, the changes in operation that the G20 agreed on, cannot be gotten through the US Congress. And so the gridlock in the US is leading to a gridlock in reform of the global global financial system. And what the result of that is the creation of new institutions like the New Development Bank and the Asian Infrastructure Investment Bank. More broadly, finance for development could simultaneously recycle the surpluses, adding to global demand, and promote development. But there are 3 impediments, and I mention them because I think they're important not only for development, but they're actually important even here in Europe. The first has to do with debt markets. There's no international framework for debt restructuring. That played an important role in Greece. If there had been a good framework for debt restructuring, sovereign debt restructuring, Greece in 2010 could have restructured its debt. And had it engaged in a deep restructuring of debt in 2010, I believe Greece would not be in the position that it is today. But there isn't that framework. The absence of that framework was recognized back in 2001 when Argentina faced a debt crisis. The IMF proposed that there be a sovereign debt restructuring framework. One of the many misdeeds of President Bush was he vetoed that initiative. It took a while until a little over a year ago for it to be brought back. The International Commission that I chaired also made a strong recommendation for the creation of this international framework. But a large fraction of the sovereign debt is written in New York, and there was a decision by one of the New York judges that was upheld by the appellate court and then not overturned by the Supreme Court, which said basically that debt cannot be restructured. Debt written in New York courts cannot be restructured. It was an amazing decision, and it has thrown debt markets in New York, sovereign debt markets, into some degree of uncertainty. Well, the response to that was an initiative at the UN, and a little over a year ago, September, there was an agreement supported by the vast majority of countries to begin work on an international framework for debt restructuring. And then just this September, the vast majority of countries endorsed a set of principles for debt restructuring. Unfortunately, the United States strongly came out against the creation of an international rule of law for debt restructuring. And it is now one of the major problems facing the internet global framework. The second thing has to do with foreign direct investment. There are new impediments to foreign direct investments arising out of the investment agreements, because those investment agreements undermine the ability of countries to regulate and provide for a dispute resolution mechanism that is deficient. And that has become a major problem in new trade agreements. So if you noticed in the United States, all the Democratic candidates and a number of the Republican candidates have come out against TPP and against TTIP, the trade agreements. And it's the investment part of that which has been the major impediment to these agreements. So again, it's an impediment for finance, for development, it's an impediment for FDI, and it's an impediment for addressing a huge number of related problems. And the third is taxation of multinationals. Following over the last 30 years, developing countries have opened up their markets to multinationals, and actually there's been a huge flows of investment across border. But they increasingly recognize that the international tax regime isn't working. Apple has become sort of a poster child of this. Apple, the largest corporation in the world by capitalization, claims that 300 and some people working in an Irish subsidiary is the source of all their profits. And then there's something called the Irish double play. It turns out that because that Irish subsidiary is controlled from the United States, they don't even have to pay taxes in Ireland. So they exist in some kind of cyberspace where their profits are not taxed anywhere. Well, they use that same ingenuity to make smartphones not to pay taxes, even though their whole product, their whole business is based on government-funded research. Without the internet, without the government research, they would not exist. But they've been willing to take, but not to give back. And it's a fundamental problem for the functioning of our global economy. Well, there's been a race to the bottom. There has been a major initiative called the Base Erosion and Profit Shifting Initiative at the OECD, and there was an agreement at Lima at the ministers, G20 finance ministers in October. I was down there for that to try to address it. But there is a broad consensus. I was on another international commission on multinational taxation, a strong consensus that this OECD initiative, BEPS, simply didn't go far enough, didn't address the underlying structural problems that have to do with the transfer price system. Finally, I want to say a few words about climate change because it is both the most important problem that our planet faces. It's an existential issue. If we don't solve it, it's clear that our existence, it's one thing to have an economy, it's the other thing to be able to live. So climate change is a real threat to our planet. They're meeting in Paris. There's been a lot of discussion about, is this the right time given the weaknesses of the global economy? And one of the concerns that I've had is that while we focused on the short-run problems post-2008, how do we get out of the global financial crisis, we've let the longer-term problems fester. One of the things I've tried to argue is that many of those longer-term problems, inequality, structural transformation, are part of the cause of our short-term problem. So you can't separate out the short-term and the long-term. By letting the long-terms fester, we've made our short-term problems deeper. Well, what I wanted to do in this last final set of comments is to emphasize that one of the ways that we could actually bring our economy back to health would be climate investment. That just like equality and growth are complementary, dealing with the climate and economic growth are complementary. The reason is pretty obvious. Investments to retrofit the global economy for climate change would provide needed stimulus to the global economy. And from this perspective, environment and economic growth are really complementary, especially if we measure growth correctly. And by that I mean take into account the effect of environmental change on our measurement of well-being. The best way, from the economist's point of view, of dealing with the problem is providing a price of carbon. It would provide incentives for investment. The problem right now is one of our scarce resources is not being priced. And if you don't price something that's scarce, you get the wrong incentives. So it's not a surprise that we're not dealing with the problem of carbon because we don't price carbon. So this would be a simple solution. Some of the revenue from the carbon price could be used to provide a climate fund for the developing countries who don't have the resources to fully address the issues of climate change. The developing countries not only are among those that are going to be most adversely affected by climate change. Finally, let me say, I believe very strongly that the success of Paris meeting is important. It's important because it's going to be important to maintain momentum. And the reason it's important to maintain momentum is that it's going to be important for the business community to realize that in one form or another, there will eventually be a carbon price. And most of the investments that we're talking about, investments in infrastructure, housing, buildings, power plants, are long-term. So if you're thinking 30-year out investments, 20, 30, 40-year investments, you have to have in mind that there will be, we don't know whether it'll be 5 years or 15 years, but there will be a price of carbon. And anybody that makes investments that doesn't build in a notion that with a high probability there will be this price of carbon within the next 10, 15 years is actually failing their fiduciary responsibility. It will happen. And I would say avoid those kinds of investments because they will go down. You've seen that in the case of coal. The price of coal shares have plummeted, and I think that finally a beginning of recognition that coal is not going to be a part of the viable mix of sources of energy going forward. So just to let me conclude in trying to say, yes, the global economy is in a weak spot today. It's likely to be in a weak spot next year. It's not inevitable. Some people talk about words like secular stagnation as if it's a disease that we caught and we have nothing we can do about it. What I've tried to argue is it's not a disease, except to the extent it's part of our politics, but it's a matter of choice. That it's a result of our policies. That there are a whole set of policies that we could change, policies about inequality, policies about austerity, policies about structural transformation. And there's nothing fundamentally wrong with the market economy. That we've made a series of decisions in Europe. I think they've made some fundamentally flawed decisions in the structure of the Eurozone. But they could change those decisions. They could change the policies. They could change the structure of the Eurozone. And with all those changes, it would be possible to restore the global economy to robust growth. But if we don't do that, the legacy is going to live on for a long time. that the destruction of human capital from the high level of youth unemployment, the low level of growth, will have long-lasting consequences. And therefore, the imperative to change the course is really great, because what's at risk is not only Europe today, we're talking about the Europe of the future. Now, I was asked to end with some questions to pose, some broad questions, just to maybe start the discussion. Will the Eurozone make the necessary reforms to restore stability and growth? Or will it carry on with its current approach of muddling through, lurching from crisis to crisis? How worried should Europe be about having a lost decade? That's almost already baked into the cake. The GDP per capita of most of the European Eurozone countries, particularly those at the bottom, is lower than it was before the crisis. I think the real debate is a lost quarter century. Will the international community succeed in Paris in creating sufficient momentum that climate investments will begin to be stimulated? And will recent discussions in the US and elsewhere about creating financial markets and firms that are less subject to short-termism succeed? I don't know if you've noticed that Hillary has made a number of speeches about how to change the financial markets to make them less dysfunctional than they've been in the past. And finally, are there any grounds for optimism that 2016 will be substantially better than 2015? Thank you.
Thank you very much, Professor Stiglitz, for this outspoken and honest state of the current economy and situation. Now we open up for some questions. So if you do have some questions, the ladies with microphones around.
Yeah. Hello, Mr. Stiglitz. It was a great pleasure to have you today and to listen to you today. I work in the Italian bank. I'm a financial advisor of one of Italian brokers. I would like to ask you, what is your opinion of the world of the derivatives and the possible derivatives bubble worldwide?
Oh, I didn't hear. Of the what?
I'm asking about the derivatives bubble.
Bubble. Oh.
Yeah. Okay. Sorry for my poor English.
Yeah.
And the next one of the bubbles that we will see.
Yeah. I think one of the concerns that everybody is worried about in the context of QE, quantitative easing, both in the United States and now in Europe, is that it has led to not just a derivatives bubble, but a broader bubble in certain asset prices. And I think that's a serious concern. And it was one of the reasons in the United States that they terminated QE. There was a worry that while we were stimulating the economy, we were also contributing to financial fragility. The underlying problem is a problem that central banks have faced for a very long time. And that is, when they increase liquidity, their intent is for that liquidity to stimulate the economy, for new production. But that liquidity can instead go to buy existing assets. And when it goes to buy existing assets, it doesn't create new production. It creates a bubble. Go to increase the price of land. And they've never been able to reconcile these two. So I don't know if you remember the famous speech that Alan Greenspan gave where he coined the word irrational exuberance. And it was in the context, he was talking then about Japan. And the debate that he was addressing at that meeting. I was there. I remember it so vividly. And what he was worried was, should the central bank worry that as it creates more purchasing power, as it creates more liquidity, it will go to create a bubble? And he gave the wrong answer. He said, no, my job is simply to worry about inflation. Now we know that that's wrong. But the mistake of the central bank, what they should have done, was to put more focus on making sure that the liquidity that they create goes to where it's intended, which is to create more jobs. What was the fundamental problem in the United States? The fundamental problem in the United States was that the part of our banking system that goes to, say, small and medium-sized enterprise lending was broken. It is still broken. What we did is, when we saved the banks with that $700 billion TARP, what we saved is the big New York banks. We didn't go into the community banks and the local banks that are so important for lending to small and medium-sized enterprises. So, and we didn't tell the banks, we'll give you more liquidity on the condition that you use this for lending to small and medium-sized enterprises or for job creation. We put no conditions on the money that was going to the banks. And so this is the fundamental mistake. They should have done a better job of fixing the channels of credit flows that help create new economic activity, not just a bubble. And secondly, they should have provided more incentives or more constraints to make sure the lending went in the right direction. So finally, to answer your question, yes, I am worried.
Theodore Modis from Growth Dynamics in Lugano. My question concerns the long-term future and assumes that many of your adjustments and other reforms you suggested have been successfully implemented. A lot of emphasis and hope, I must say, has been put on growth and the prospects of growth. Now, do you believe it is reasonable to expect that developed economies like United States and Western Europe will keep growing indefinitely in the long term in the absence of widespread destruction coming either from some major warfare or other big-scale catastrophe? The Japanese economy hasn't grown for the last 30 years, and the country seems to function. Is it envisageable to have a sustainable economy in the absence of growth?
Yeah, I think there's an important distinction I want to make, which is a distinction between growth and growth in income per capita. If you look at Japan, the reason that it's grown so slowly is that the population is actually beginning to go into decline. The workforce in Japan has been declining at the rate of 0.25% a year. So, to me, what matters is our standard of living. It's not GDP as a whole that's important, it's our standard of living. And we will need to get our population under control if we're going to address the problem of climate change. And in Europe, there is except for the migrants, which I can't obviously ignore, but except for the migrants, the population is basically stabilizing in Europe. So in those terms, there doesn't have to be a growth in the only growth that you want to focus on is growth in per capita income, not in overall income. Now, I think going forward, because of climate change, the nature of the growth will have to be changed. That is to say, it will have to go from resource-intensive growth to service sector, things that don't require as much resources. And I think there is a lot of change. You know, the service sector that I talked about is not as resource-intensive. If you look at the early stages of development when people are building houses for the first time, building, transportation systems, the resource use goes up. But in the second phase, resource use per unit of GDP goes down. So I think that it may be possible for us to continue to grow without the magnitude of the impact on the environment that we've had in the past. In fact, we can reduce the impact on the environment. The third thing I would say is, overall, if I look at the standard of living of my colleagues, most of us, I don't think we need to continue to grow, actually. But I don't think we should. We have to recognize that there are large fractions of our population that do not have this basic standard of living. So we will have, for a long time, a need to grow to make sure that all the people in our society can come up to live to a modicum of a decent standard of living. But once we get there, I think this kind of growth fetishism is wrong and dangerous. So I think we ought to begin to rethink about what is important, and I think the kind of question you ask is really important, because I do think we ought to get out of this growth fetishism.
Hello, this is Andrea Moreggio from Amfin in Lugano. I really enjoy reading Professor Stiglitz's books whenever I have the opportunity. I love his diagnosis about the problems in the world economy. Regarding, I have a lot of thoughts also on the treatments, and one of the suggested treatments now at this juncture is to increase infrastructure spending, spending on climate change, all activities that fall within the government sphere. We tried infrastructure spending before. For example, in the 1960s and 70s, it was popular to have government projects. Then we got disaffected, and now we seem to be coming back again to this idea. Is there an optimal level that the government should have in a developed economy? What's the percentage of GDP that Professor Stiglitz deems optimal to spend for a sustainable developed economy these days? For example, in Italy, we have government spending that is over 50% of GDP. Is that where we should be going, given that growth is not the objective, or is there a different mixture that he would suggest?
Yeah, that's a good question. Let me try to reframe it a little bit. First, I don't look at the overall GDP, government GDP ratio as a critical variable. It really depends on what services the government is doing and how well it does it. So, for instance, in the United States, we have a largely private healthcare system, and say France has a largely public healthcare system. The US spends 17% of GDP on our healthcare system, and France spends 11% of a smaller GDP on its healthcare system. But the outcomes in France are much better than the outcomes in the United States. So if you asked me, would I be happier if we switched to a French-style public healthcare system where the total spending goes down, but the government share goes up? I'd say it's a no-brainer. It's obvious. If we could do that, there may be something that France is better at doing these things than America. But if we could do what France is doing, it seems to me it's a no-brainer that it'd be better off in the public sector. Just as an aside, I don't know if you saw the recent study that came out of Agnes Deaton, who will be getting the Nobel Prize this year for economics. The life expectancy and the health status of American middle-aged white males has been falling dramatically. And we've always known that life expectancy in the United States is lower than in Europe and in other countries. But it's always been said, oh, because we have a racial problem. And what he's been able to show is now, in the more recent data, even the whites are declining. And it's declining because of an increase in suicide, alcoholism, and drugs. Of social diseases that are predictably the consequence of the decline in incomes that I described, that I mentioned earlier in my talk. So, I think one has to recognize that there's some real social diseases, social problems that are going on. So, the issue of whether some of the infrastructure, public infrastructure, is done in terms of the official public budget or in terms of something like the European Investment Bank, which is off budget, again, is an institutional arrangement. But what is clear is that the social return to investments in infrastructure are very, very high and much higher than the cost of capital. And so our economy is suffering a great deal for not doing that kind of investment. If you were to ask me, what is the number right now for the United States for spending on the share of government spending, I think we need to spend a lot more right now because we've underspent for the last 25 years. For a country that had not created the kind of deficit, then they don't need to spend so much because they don't have to take over the deficit. So I don't look at an aggregate number. What I try to do is look at it piece by piece and say, is that kind of spending yield a social return greater than the cost?
Thank you very much. Now, one last question, please.
Hello, my name is Iñaki Lopez, and it's an honor to be in front of you and ask you a question. The question is, does it make sense to invest in a renewable energy firm that invests in emerging countries, in Colombia, Chile, Peru countries, for example?
Yeah, I think renewable energy, it does pay to invest. Obviously, it depends a lot on the circumstance. And the reason why I think, it goes back to what I said in my talk, I think there will be a price of carbon. I think that price of carbon will be enforced globally. One of the things that is going to be very important is an enforcement mechanism. The enforcement mechanism, I think, will be like in the Montreal Convention, which dealt with the ozone hole gases, that countries that don't have enforceable carbon prices will face very high tariffs on the export of their goods. So I do think over the next 30 years, there will be an enforceable price of carbon that will be fairly high. So one ought to begin to think about investment in that area. I can't talk about any particular country, but what is one of the things that the world global economy advantage right now is China has made very large investments to bring down the cost of solar panels. And other research around the world is bringing it down even further. There are really breakthrough technologies going on in solar panel, and also on wind, efficiency of wind generation, and then efficiency of storage and mixed systems. So given that, the cost advantage, you might say the cost disadvantage of renewable has come way, way down. Right now, in most countries, the major cost of implementation of renewable energy, say for solar, is the installation of the panels. That's labor, very labor-intensive industry. But in emerging markets, the cost of labor is relatively low. So particularly given the low cost of labor, it makes a lot of sense to install, so it's a labor-intensive technology even when you think about it. When you think about having, with the ability to import it from China at at a low cost. So to me, I think there ought to be a lot of thought given to these renewable technology. It's happening at a massive scale, even in the United States, but I think given the factor prices, it even makes sense for emerging markets.
Thank you very much, Professor Stiglitz, for this discussion. Thank you.